0.85 trillion down here in late 2008. Now we're at almost $5.2 trillion. So far, the benefits have been scarce in the economies of those countries, but at least in the United States, the effect on the stock market have been substantial. And we can look at the next page on that. This shows you, of course, what the stock market has done in its tremendous jump from 2009 to present, and the timing of the various Federal Reserve stimulus exercises. So after a series of successes like this by the Fed, and you can see that they've come in pretty close to the bottoms of the major, I won't say even major dips, these were about 19-20% or so they weren't huge dips. And they have come in, and each of the rescue efforts, at least to date, has been quite successful. And when you go through a situation where the Fed has been successful like this, you often hear the commonly used mantra, don't fight the Fed. And most of the time, if you follow that, you succeed. The Fed, in general, makes markets go higher. But it's not as simple as just following the Fed. On this graph, you can see the precipitous decline that took place right before there, and it actually started a little bit higher right about over in here in 2007. It's also important to note that the Fed was dropping rates all the way down from up here down to here. So if you followed the Fed in that instance, you were down about 50%. And yes, it's been very helpful to follow the Fed in this instance because you've almost got your money back. There are a couple of other fairly egregious examples where following the Fed would have cost you a fortune. The worst of them all was 1929 to 1932. The Fed was dropping interest rates all the way down in what ultimately proved to be an 89% decline. Now, admittedly, there aren't too many of those, but once you've lost 89% of your money, it's a tough way to get back. And if we look more recently, even apart from this major decline, the Fed was dropping interest rates all the way through 2000 to 2003. Another roughly 50% drop in the S&P, but about an 80% drop in the NASDAQ. So again, if you followed the Fed, don't fight the Fed, and you were a NASDAQ player, you lost 80% of your money. And it's wonderful if you followed the Fed since, because you've got some of it back. But you're still down about 40%. So it's good to know things like follow the Fed, but it's also historically proven that it can be destructive to your wealth if you are slavishly tied to that mantra. The next couple of pages show where we stand with the debt problem. U.S. debt condition remains precarious. This is a graph that I've been showing at these conferences for about a decade or so. A quick reminder and a real quick explanation for those who are new to the conference. This, like one of the other graphs, is a ratio. This shows the total credit market debt in the United States as a percentage of the economy as measured by the gross domestic product. And this shows you the equation. Debt here of 54 and a fraction trillion, GDP of 15 trillion, and we are currently a little more than we have about 350% more debt than we have gross domestic product. And it is interesting to note that we have had only one other spike besides this one. This was in the Depression of the 1930s, and it wasn't that we suddenly increased our debt so much. Remember, this is an equation. This was because the denominator of the equation, the economy, simply plummeted. So the ratio skyrocketed. And the unfortunate precedent from there is that much of this debt was never paid off. Much of that debt was simply defaulted away. And we have no idea how this much greater rise in debt relative to the size of the economy will ultimately be resolved. We see the beginning of some change here, but again, and we hope it's not precedent to this, much of this comes from foreclosures. So what we're seeing is, yes, the ratio's coming down, but a good part of it is simply because of foreclosures. The next page shows we're in widespread company as a debtor nation. This is gross government debt to GDP ratio. So this is, that other graph showed debt beyond just government. It included our debt and financial debt and so on. This is more restricted. This is gross government debt as a percent of nominal gross domestic product. And you can see here, these last three filled in bars, by the way, are estimates from the OECD, Organization of Economic Cooperation and Development. And you can see how dramatically, post the 2008-2009 crisis, how dramatically the world's debt to GDP levels have soared. It's instructive to recognize also that Reinhart and Rogoff, to whom I have referred many times in the last year and a half or so, who wrote the really magnificent academic work called This Time is Different, conclude after studying financial crises over a period of 800 years that governments in that 800-year time frame, and I think they cataloged 360 some crises if I recall, that they indicate that real troubles for governments begin when the debt ratio gets up around the 90% of GDP level. Well, clearly, we're well into the danger zone, and this is multi-country. This is not a single country. So we have by all historical precedent, we have an extremely volatile, dangerous debt situation. Yet, what we've heard repeatedly over the past few weeks that I referred to in the title is that Europeans are rejecting the austerity measures that are designed to bring down the deficits and not even bring down the debt, just not contribute as much to the debt in each of the years ahead. The elections this past weekend clearly reflect that. Voices are getting louder, calling for growth measures. We've probably all seen that, read that in our newspapers. Now that means more deficit spending and bigger debts. The austerity measures have lasted, except maybe in Greece, less than a year. We as a population don't like austerity. We don't want the candy to be taken away. We certainly don't want anybody to prescribe castor oil. In our country, Ben Bernanke has stated that he stands ready to employ QE3 if he sees conditions that require it. The public has been dulled by the daily talk about more possible policy interventions because the sky hasn't fallen. We've heard a lot of worrying. I certainly have been one that's been vocally worrying for quite some time about the rising levels of debt. But the sky hasn't fallen, and we've even gotten to more and more debt. And the listeners have come to take this situation that we're in now somewhat as business as usual. To talk to the Fed, for the Fed to be talking about QE3, or for the European central banks to be talking about greater amounts of rescue money. This is extraordinarily dangerous. the world has never done this before. We're on